Did you know that over 60% of Americans don't have enough savings to cover a $1,000 emergency? Shocking, right? Even more surprising, 1 in 3 people are living paycheck to paycheck. But here's the kicker: you don't need to be rich to turn your financial life around. In fact, some of the most successful investors started with almost nothing. You may be thinking, that's easy for the wealthy to say. But what if I told you that anyone, even with limited funds, could use simple strategies to escape financial stress? That's where value investing comes in. In this video, we'll uncover how you can go from being financially strapped to achieving true financial freedom. We'll show you how the world's most successful investors, like Warren Buffett and Peter Lynch, turn small investments into massive fortunes, and how you can do the same. Stay tuned as we dive into strategies you've never heard before, all backed by real numbers and proven results. Ready to learn how to make your money work for you? Let's get started. Chapter 1. The Wealth Awakening. Shifting from scarcity to opportunity. To begin your journey to financial freedom, you must first shift your mindset. Most people see wealth as something reserved for the lucky or those born with money. But that's not true. The reality is, financial success is about finding opportunities that others miss. As Warren Buffett famously said, the stock market is a device for transferring money from the impatient to the patient. When you embrace value investing, you stop thinking in terms of scarcity and start seeing abundance. This mindset allows you to recognize undervalued assets that can grow over time. Value investing is about playing the long game. It's not about getting rich quick but about consistently making wise decisions. Research shows that investors who focus on long-term strategies outperform day traders. According to a study by Dalbar, long-term investors earn an average of 4.1% annually, while those trying to time the market only earn 2.5%. By investing in solid, undervalued companies, you allow your wealth to compound naturally. Once you begin thinking like a value investor, you'll start looking at the market differently. The key is to spot mispriced stocks. This happens when the market panics or when there's a temporary issue that lowers a company's stock price. These moments are opportunities, not obstacles. The trick is knowing how to find them. You don't need a huge capital base to start either. Even small, regular investments in undervalued stocks can build significant wealth over time. You just need to be patient, consistent, and strategic. Chapter 2. Stock Market Myths Busted. Separating value from hype. A lot of people think you need to be wealthy to invest in the stock market. That's simply not true. In fact, most successful investors start small. Take Peter Lynch, for example. He grew the Magellan Fund from $18 million to $14 billion by identifying hidden gems in the stock market. His strategy was simple: find companies with solid fundamentals that were undervalued and hold them for the long haul. Another myth is that the stock market is only for risk takers. The truth is, risk can be minimized through careful analysis. Value investors, like Benjamin Graham, taught us how to assess a company's true worth. By looking at fundamentals like earnings, debt, and cash flow, you can find companies that are undervalued and have a low risk of failure. One common misconception is that stock prices go up and down unpredictably. But the reality is, prices are driven by news, emotions, and perception, not always by the underlying value of the company. By staying disciplined and avoiding the hype, you can make smarter, more profitable decisions. Another myth is that you must be able to predict the market to succeed. Research shows this isn't true either. According to a study by the CFA Institute, investors who stick to a value strategy have outperformed those trying to time the market over the past 50 years. Chapter 3. Bargain Hunting. For your portfolio, identifying undervalued gems. Think of value investing as bargain hunting for stocks. When you walk into a store, you're always looking for sales, right? The same principle applies to the stock market. Value investors search for companies that are undervalued based on their intrinsic value, what the company is truly worth. To identify these gems, you need to understand key metrics. For example, the price-to-earnings (P/E) ratio is crucial. If a company's P/E is lower than the industry average, it might be undervalued. But don't stop there. Look at other ratios like the price-to-book (P/B) ratio, which compares a company's market value to its book value. You also want to check out a company's cash flow. Companies with strong, consistent cash flow are less likely to face financial troubles. The trick is to find companies that are overlooked by the market but have solid fundamentals. Sometimes, these undervalued stocks are hidden gems because of temporary challenges. Maybe a company's stock price drops due to a temporary issue, like a supply chain disruption or a change in leadership. If the company's long-term prospects are still strong, this can present a buying opportunity. If you're finding this content helpful, don't forget to hit the subscribe button for more expert tips on building your financial freedom. Chapter 4. Compounding Gold. How Patience Turns Small Investments into Big Wealth. One of the most powerful tools in value investing is the magic of compounding. Einstein once called compound interest the eighth wonder of the world, and for good reason. When you reinvest dividends and capital gains, your wealth grows exponentially over time. Let's say you invest $1,000 in a stock that grows at an average rate of 8% per year. After 10 years, that $1,000 would become over $2,158. The longer you stay invested, the more your money works for you. This is why value investing is all about patience. Most value investors know that stocks go up and down, but over time, good investments tend to rise in value. In fact, according to a study by the Motley Fool, a diversified portfolio of value stocks outperforms the market by about 4–5% annually. The key to success with compounding is to stay consistent. Regularly investing in undervalued stocks allows you to take advantage of market fluctuations. Even if the market drops, you continue to accumulate more shares at lower prices. Patience is not just about waiting for growth. It's about waiting for the right opportunities to emerge. By sticking to your plan, you can watch your wealth grow over time without needing to make drastic moves. Chapter 5. The Safety Net Strategy. Building wealth without the risk. A common fear among new investors is that the stock market is too risky. But value investing isn't about blindly taking risks, it's about minimizing them. One of the most important strategies in value investing is risk management. The key to safety in investing is focusing on companies with strong financials. Look for companies with low debt levels, consistent earnings, and a history of profitability. The less debt a company has, the less risk it carries during economic downturns. Diversification is another powerful tool for reducing risk. By spreading your investments across different sectors and industries, you're less likely to be impacted by the poor performance of one stock. Research from Vanguard shows that a well-diversified portfolio can reduce risk by up to 40%. Another way to build a safety net is by investing in dividend-paying stocks. These companies tend to be more stable and offer regular income, even during market downturns. The steady cash flow from dividends can help balance out any potential losses from stock price fluctuations. Ultimately, the goal is to build a portfolio that balances risk and reward. You want to take calculated risks, not gamble. By focusing on undervalued, financially healthy companies, you can create a solid foundation for wealth without exposing yourself to unnecessary risk. Chapter 6. The Financial Freedom Formula. From first investment to passive income. Once you've built your value investing portfolio, the next step is to turn it into passive income. This is the key to financial freedom. The goal isn't just to accumulate wealth but to create a stream of income that doesn't require constant effort. Dividend-paying stocks are a great place to start. As your portfolio grows, you can reinvest your dividends to buy more shares, which then generate even more income. Over time, this compounding effect creates a snowball of income that can eventually replace your regular job income. But dividends aren't the only way to create passive income. As you build a diverse portfolio of undervalued stocks, you can also sell portions of your holdings when needed for cash. This strategy allows you to live off your investments without liquidating your entire portfolio. Studies show that passive income from investments can allow you to retire earlier and live a more flexible lifestyle. According to a study by the National Bureau of Economic Research, people who invested in diversified portfolios of stocks and bonds were able to retire 5–10 years earlier than those who didn't. The formula for financial freedom is simple: invest wisely, stay consistent, and let compounding work its magic. By focusing on undervalued stocks, managing your risks, and reinvesting your earnings, you'll be on the path to financial independence. Don't forget to subscribe to the channel for more valuable tips and strategies to help you on your journey to financial freedom.